Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. When I think about what it means to be an owner, it really comes down to good decision making. How are we choosing to spend our time and our money, and are we allocating our resources in a way that actually make it worth it? And one of the things that I've learned over the long period of time I've been doing this is understanding the game of ownership is one of the most important parts. And that's why Expand Knowledge is the first module in the IBD playbook. And Candice Bradley, who's going to be on the podcast today, it's such a fun conversation because she has worked in so many different ownership structures, from venture capital to private equity. She was in investment banking to very large public companies. And then she helped scale her own privately held business that she owned from 0 to 10 million bucks. And every one of them, those ownership structures have a different rule structure of like, what's our desired rate of return and what timeline, how do they view cash? And so Candace and I are going to have a detailed conversation about those different types of ownership structures and what her journey's been like. And then we wrap up the conversation over at around an hour mark. The last part of the conversation is all about how do we determine where to spend our time and what's worth it. And it was so fun because the first hour allowed us to have that second half of the conversation where we're talking about making decisions, making the decisions of where to spend our time and whether we should do something or not, because understanding how valuations work become absolutely paramount in order to truly make that decision. And so what I actually just did recently is I launched a new newsletter. You can go to ryantansom.com and go to the newsletter tab. And I just launched a bunch of articles on business valuations. I created this framework, the 3 lenses of valuations. So go jump into that and start consuming the material, because I think thinking about valuations and understanding them is going to be key to be able to have the conversation that Candace and I are, as well as then be able to make better decisions for yourself. Thanks for tuning in, and I hope you enjoy the conversation with Candace. Candace, I'm so excited. I wanted to just jump right in because we did a panel last week that I'm sure you and I both have thoughts on. God bless you, Graham and Kyle. You're probably listening in. Thoughts on that. I couldn't tell you how pumped I was after you and I talked and met like a month ago.
Yeah.
I was just like, the conversation level that we had, I was able to just jump right in at like level 9 or 10. Yeah. Like I was like, holy shit, this is so fun.
Yeah.
So let me give you, I'll put a container on this and then you can kind of give the listeners a story arc and then we can navigate within it. So after talking to you, the reason I thought we were able to jump in at level 10 of the conversation is your background in private equity, VC, operations, tech, like forecasting out the leading indicators of models and then rolling it all into the financials.
Mm-hmm.
Your deep understanding of valuations and like how like the idea has to come and generate cash flow.
Right. At the end of the day.
At the end of the day. And it was so super cool because we talked about the difference between private equity, venture capital, you operating your own businesses.
Right.
And then being the forecaster and the financials and just seeing how all operations and finance connect. So that was kind of my takeaway, and like lots of cool idiosyncrasies inside the conversation. But like, I don't know. That's why I was pumped.
Sure. No, I felt the same way. And it was interesting because I often, when I talk about what I've done, where I've worked, being an entrepreneur, I often have to like segment.
What do you say?
Right. It's hard, right? Like, it's like I have to segment it, or I'm couching it with, I've done a lot of different things. I've had a very non-traditional career, right? Instead of, kind of jumping right.
And whether you want to talk to them or not, I do finance shit. And you're just like, I don't want to, I don't want to talk to you.
It's like, you might not understand. Right. And so from that perspective, it was so nice, again, to be able to just jump in and have the conversation and not have to do all the caveating. And
oh, it's so fun. So because like I want, I've got like various rabbit holes I want to go down, but I want to make sure that we bring the listeners on a journey. And I think your background would be a good place to start, but just to plant a couple of seeds, like I said, like I'm fascinated about diving into like the connection of operations and like the forecasting of like what products and services do all the way into the financials. So that's a unique, um, idea we can put in the parking lot, as well as the differences of VC, private equity, your own business, and the game of ownership of like the ownership of the entity, whether it's, there's different ownership structures and how those impact the mandates of cash flow and equity. And so, but like before, jumping into where we probably could go with all those, like for the listeners, like, I mean, how did you get to understand all of this stuff?
Yeah. You know what? Again, it was very much I think it started unintentionally, actually. It was very much unintentional in the beginning, in that I kinda started in banking and private equity more from the perspective of I was coming out of undergrad, and I just kinda had this thought process of what's literally the most difficult, kinda thing I can do. And for me,
Why even
I
banking and private equity? I mean, you just skip past it. Everybody listening in here is like, what?
like,
Like
what?
that was so exciting. I couldn't wait to graduate and get into
And just devote my life to
yeah.
financial services, which literally I did. And that's kinda how it came about. I had internships in college, and they were always in finance, so, like, I am that person who started as a finance major,
Why
even
did you like it though? Like in finance or accounting, and like what's
yeah.
what was the
Kind of
pull?
the nuance. So for me, accounting, so my husband's an accountant. Accounting was different. It was very structured, very rules based. And I'm sure this will come up in the conversation. A lot of the rules I was just kind of like, why do we do that? And why does that make any sense? And but what about this? And it felt like they weren't quite accounted for from an accounting perspective. But finance is kind of wide open for interpretation in many ways. And I think also kind of this missing piece around how the business is actually doing and how it should actually be structured.
What got you interested in even to study it? Like, I mean, I think about
Yeah.
Candace, like my running joke that my listeners are sick of is like, I got a D in accounting, and I remember that blue book that was debits and credits. I'm like, what the F are they talking about?
In the
I
literal.
don't care.
Right.
And then like the guy was crazy with this chalk all over his face, and like and so like and that was the accounting, but
Yeah.
finance
Yeah.
I got interested, I mean, for me, like I backed into all this stuff because, like, in the family business, like we have no money,
Right.
so I had to figure out why we don't have any
Right.
money for the
Right.
checking account. But like, why did you decide that your parents entrepreneurs? Were they
No,
finance
they are
people
not. So,
or
what's interesting is that my parents are both salespeople by background.
okay?
So, they ran large sales teams. My mom at a cemetery, no doubt.
Oh no way!
Yeah, and my dad
How do you selling
there's
coffins?
there's so much to talk about here.
I know that didn't come up last time.
Right?
Like, how
Yeah,
do you manipulate
how do
those
you
numbers? You just go add some more bodies.
right? So, my mom there and my dad sold electricity to corporations, like large electric accounts to
Oh,
corporations,
interesting.
and so that was their background, and so neither of them finance or accounting. So these internship programs, so I essentially had exposure to different parts of business prior to starting college. And so got to chat with accounting professionals, was able to chat with finance professionals, but then also just general management professionals. And what struck me about the finance professionals was just how autonomous, one, they were from a decision making perspective, and then how many different ways you could kind of slice the problem. I am inherently a puzzle solver. Like, I love puzzles, I love like putting pieces together. And so finance was the only, and at that point in time, in my view, the only kind of discipline within business where I could still do that.
So I think you just I think you just found the common thread that I have noticed. And like, because I stumbled into finance that way, where like it, it's how the world works, right? And like, and I'm trying to even think of how they'll get the words out of my head because like I've gotten self-conscious over the years of like, okay, now I'm a finance geek, and it's like, no, like here's the like it's really interesting because like I think about it in the health the same way as like discipline sets us free, and like if we understand the core principle, like the first principles, like how does the world actually work outside of all of the jargon and all the concepts, and like we were talking about that on the panel where like we have to have cash after everything's said and done. And then we take that cash and then we reinvest it back into ideas to create more cash. It's just that simple. And there's all these different intricacies inside of that. But if you want to see the full puzzle, we have to understand how that works so we can have more freedom and autonomy and independence for ourselves. So like, I think that's where I see so many people get stuck, is they think that that doesn't have to happen. And it's like, well, you actually have to learn how that stuff works so you can actually be free and forget it actually.
Yeah. Well, it feels like finance is one of the most frequently outsourced like disciplines within small business, right? And to your point, because it is described in such a way that is very nuanced, very complicated, and it is, not no doubt it is, but those are layers. The foundation is simplistic.
Well, and you and I were talking about this on the panel last week, where it's like, I believe that most Americans have outsourced their health. How's that working? Right? I don't even know if I have to say anything else. It's like, well, guess what? Your doctors are selling you different things based on the insurance code, whether it's pharmaceutical drugs, or whether it's cutting and prescribing and like surgeries or whatever. Like, you're going to be like subject to the machine of incentives of health, when really, like we were talking about, sleep well, eat well, push something, pull something, and do some cardio. And like, and finance is the same way, where like, I literally think finance and health, we can't outsource the understanding of this stuff. And why I find it so fascinating talking to people like you, because then it's like, we can just talk about how it works
Yeah,
and then like the real game.
yeah. No, exactly. Exactly. And we all need to understand it. Not to the same level, but we all need to understand it.
And I think and then that's what I want to get through with this conversation, is like the different layers of the onion. Like, we can unpack them, but at the end of the day, it is more cash. So you in college went to finance. Maybe like, you could zoom in on the finance versus accounting, because I talk a lot about that too, especially when we're talking about like where a CFO came from, or or someone's understanding. So how would you describe the
Absolutely.
difference of the two?
So accounting is technical. It is the actual inputs that are happening to get to some output. However, that output is somewhat, I would say, manufactured, right? There's kind of some false precision around that output. And that false precision has a purpose, right? Like, this is not to say that accounting is not important, because it is. The purpose around that, to some degree, is to have this shared language to be able to kind of have these
To some degree.
comparison points, right? We want to have these comparison points. So you want to say company A in ABC industry can now be compared to company B in that same industry, and kind of use these, you know, somewhat complex ratios and things of that nature to do the comparison. What becomes difficult, I think, is that understanding each of those components, some of those components are indeed engineered. Um, again, in order to have that simplicity across a group within an industry. And so if you don't understand the engineered components, then you don't understand what leads to reality. Exactly. And so finance, though, I would say, is pure reality. And again, I'm biased because I enjoy finance more, maybe. But finance is kind of getting to that reality. And so there are definitions that, as an industry, we have tried to standardize, but in its basis, it is: how much money are you making? How much money are you spending? And what is that result? What do you do with that money once you make it and spend it?
Love it. Love it. And I want to get back to like your story arc too, but then we're going to juke and jive. So bear with me. Well, I think it's important because, and I want to hear how this showed up in your journey to like scaling up a company up to 8 figures personally of your own operations, after having some time in PE, some time in VC, and even with Raymond James. And but like going like I think this foundation is super important, Candace, because like the engineered reality of, or the engineering of the balance sheet, it's like, okay, what is goodwill? What is retained earnings? And retained earnings is not cash. Your IP, what are you going to throw on there? Like, and at the end of the day, you've got like the financial statements that have to be clean and accurate, and understanding what's on them. But then when you talk about finance, and what you've done for most of your career is like trying to predict the future. Right. So like they have the understanding how they both correlate. Cause I talked to, there was some investment bankers that I used to work with, and like they had no idea how the numbers got onto the financial statements. And that's where I think there could be risk, right? Is understanding, okay, like, because if you're taking a leap of faith trying to end, do some forecasting if you
No,
don't know how the numbers got on the financials,
exactly.
right?
Exactly. No, it's such a huge difference, right, between the 2, and to your point, in thinking longer term and future oriented, a lot of time and we can, kinda go down this rabbit hole too, but a lot of times you're looking very historically, right, and you're looking at
Hmm.
those historical accounting, kind of definition oriented items and saying, "How does that extrapolate to the future?" When we know that that's not predictable. We can make
Hmm.
best guesses and we can kinda make comparisons, but we know that that's not predictable.
So take us back to then, like, like your brain trying to build the puzzle, see
Mhm.
the
I
puzzle,
like
like,
puzzles.
like
I
puzzles,
like puzzles.
and
Um,
future oriented, because like
yeah.
where did this start to show up in your career path, and like
Yeah.
why were you chasing what you were chasing?
Yeah. So interestingly, my junior year, in undergrad, I had, an internship at Bank of America, trade finance group. So 100% accounting oriented. And so which was necessary, right? Because I mean I had to understand the foundation in order to do it. But man, was it not me by in any regards. And but we had, kind of these intern events and we met other people across the firm and I met the investment bankers. And that is kind of what changed it for me. And we, kind of talked about, so what are you all doing exactly? And okay, you're providing financing, you're hopefully providing sustainable financing, or you're providing, and that I did investment banking in 2004. So there are many a deal that maybe in hindsight weren't the best, but based on the information we had at the time, these were, they could withstand 10 times leverage. And we could
Now we're at
yeah,
30,
yeah, right?
40.
Like, why
It's
not? Yeah,
fine.
it's fine.
It's
They
fine.
made it. All these companies made it. Um, and so that's what really kind of opened it up. For me, it became this world of finance kind of turned from this, not just this kind of forward-looking tool to use to kind of manage a company with, but then also being a lot more conscious and strategic around how do you use external tools in conjunction with that forecasting capability to then really hyper grow an organization? Or in PE case, kind of achieve steady state growth, but kind of know which levers to pull. So that's where it became just kind of opened up a complete world. I didn't know any investment bankers before this point in time. I like no one in my family and no one in my friend group had this, and so this just opened up a complete world that I was completely unaware of, at that point in time, and I just loved it. It was
You know what
fascinating.
I've well, and what I find fascinating about this space that I'll loosely say we're in, because we're trying to bring this, like we were on the panel last week, bring this level of thinking to the owner operator who didn't have this background. What is still the same is we're just trying to predict the future, right? And then we're trying to make sure that we're staying aligned with the ability to increase the odds that we
For your
accomplish
brain.
our goals.
Right,
And
exactly.
yeah, and like, so what was your like? What was it like in the different owner, or the different companies and industries that you worked in
Mhm,
private equity versus venture capital versus like Raymond James versus your owner operator?
mhm.
Like, how were the games different in each of those, and what was guiding the games?
Yeah. They were all completely different. So so
Hmm.
first 5 years of my career was, like, first 2 years were investment banking, next 3 were private equity. My private equity time was actually, again, a very, very pivotal one for me from a career standpoint because it was kind of post, deal activity. My first year, we definitely, kind of, completed a ton of platform acquisitions, a ton of add-on acquisitions, so it's very much financial engineering, like what you would expect from a private equity perspective. Very true to that. But then 2008 happened in the middle of my private equity time, and so we had obviously portfolio companies who that were very much, kind of centered in commercial construction and, real estate. And so it was not the best time for any of those companies. And so it was the first time we kind of switched hats, at least for me, switched hats from financial engineering to like we literally need to make sure that our companies can make it. And so in order for companies to make it, we had to actually sit with our management teams and talk about all of those
I'm
potential
sorry for
improvements,
laughing.
right?
Like, holy
Right?
shit, we got to run this business
We
and
have
make
to
sure it makes
run the
money.
business. Exactly. And so that meant, in many respects,
Uh,
cost cutting, which brings about a whole host of other, kind of situations that perhaps could have been avoided in some instances or not, but we were so much in growth mode. But it really became this tremendous focus on actually operating the companies. And that was so unique and different for me because again, up to this point, it was
mhm.
much less about operations and much more about financial engineering. Like how do we make the company bigger via acquisitions or financing or, like some
Yep.
other growth
You
mode.
know, let's double click on this because
Mhm.
before even getting into venture capital and like what you were doing, some of the other companies, I think because you and I spent a decent chunk on our first call, like talking about the macro environment and what's going on, and I think the reasoning behind why, and like so financial engineering. When I hear that, what I think of is what is the normalized EBITDA? How do we figure out what that is? How do we figure out the multiple is? What is the deal structure and the combination of debt and equity to get the rate of return that we need? And it's all of those levers that are being focused on from the investor and investment perspective and making sure that then the numbers all come together based on the assumptions of the future. So I want your thoughts on that, and then my follow-up that I wanna hear is, like, what you and I talked about on our call is, like, that was fine from 2008 to 2020 or 2022 when 0% interest rates where it's essentially like it's effectively like refinancing your house every year as it goes from 18% interest down to 3 every year your monthly payment gets lower so you don't have to focus on making more money as a W2 household. And so like all of a sudden we go wham and now it's like holy shit we need to make money and you were in the construction space but now I think what you experienced in 2008 and what I also experienced too, Candace, in 2009, because that's what when I had my family issues too with our family business, we both went through that right when the cocktail party started for everybody else. So now all of a sudden the rest of the world is going, holy shit,
What do
we need to make money.
what do we do?
So like, is it like, any thoughts about like the financial engineering versus kind of the macro environment and like why things have been happening and why the paradigm is
Yeah.
shifting?
Yeah, so to your point, the financial engineering was very much, an option, because of the environment that we were in. It was I mean, again, that's the same reason why you could have 10 times leverage on the company. It's the same reason why companies could IPO, um, faster maybe than they traditionally would have been able to at that point in time. And, kind of the low interest rate environment allowed them to grow much faster, and them being able to grow much faster meant they had more access to capital. The capital was cheap, and so we could,
Just this
kind of make
cycle.
it's a
Yeah.
cycle. We can make all these things happen, and there was so much investor appetite from a just a private equity, investor perspective that you could move, kind of companies from portfolio to portfolio, make the marks, raise more funds, right? So it was just kind of all cycles
Mhm.
work together to kind of create this hyper engineered environment.
Well, and the reason that the industry was so so attractive is because the pension funds, the endowments, and the insurance companies, there was 0% interest rates, which made
So
the
the
no money on
multiplication.
bonds, so they had to go to private equity, which enhanced the I mean, like, you just think about how many factors went into this, and people just have
Mhm.
gotten so used to this over 16 years,
It
and
was
you're just
the
like, it's
expectation, right? It was the expectation
right?
that you would
So
continue to and it's funny 'cause I this did not become as pronounced to me until I was actually in private equity and we were kind of raising, subsequent funds and things like that, but you really only needed 1 or 2 companies to do well, right, in a fund. So talk about even financial engineering, another layer to
yeah,
that.
yeah.
You have this portfolio, you have these funds, and, like, that some companies will work out well and some companies won't, and that doesn't matter because the 1 or the 2 could make the entire fund, and you could keep rinse, repeat on.
And you have tax write-offs on the ones that lose money, so it actually enhances the fact that you only need a couple to
Exactly.
to win. I mean,
Exactly.
yeah, it's
So, I
yeah.
mean, that was the hamster wheel, right? And so when 2008, 2009 happened, that hamster wheel was interrupted in so many regards. And it, like I said, kind of became this focus around what do these companies actually do? And obviously that's
Well,
an exaggeration,
no,
but
but kinda
yeah,
not. Like,
yeah,
who are the actual people running the businesses, right?
yeah,
Like, what are they actually doing? How are they making decisions? And it got interrupted for you because of your exposure to construction, it sounds like. But like the cocktail party was just getting started for everyone else. So like, I mean, every industry has been touched from veterinarian clinics to eye clinics to, I mean, every single industry, all the way to home services since COVID. So I mean, it's interesting that like your experience with the reckoning happened then, but it wasn't because interest rates and all the other financial parts. It was because the industry exposure to the
the
economy,
commercial
right?
real, right, exactly. Yep, exactly. Um, Yeah, it was a really interesting time. But so essentially what happened is operations became this huge focus. We, kind of looked at team employees and said, well, we maybe have too many. We looked at technology spend and said maybe the ROI isn't there and we shouldn't, kind of invest in that way. We looked at management teams really hard and, kind of thought more about their backgrounds and their skill sets, what they had achieved, what they had not achieved, and kind of determined where adjustments were. So it was it was tough, but very
Hmm.
necessary kind of reckoning.
So one thing I think the listeners could benefit from is like how, because everything that you just said is applies to every business. It
Yeah,
should,
no,
anyways.
exactly. Exactly.
But the difference between a private equity firm with loads worth of debt and variable interests versus an owner operator of like my groups where like they don't have all that debt. So they can like how does that constraint of debt, cash flow, and working capital, all that? How are you dealing with the constraints, and how would it be different for someone that doesn't have all that compared to like I mean, maybe where does debt play a factor into this?
Yeah, like the flexibility becomes much less, right? So essentially you have like you don't have as many levers to pull at that point.
Yeah.
And so essentially with this level of financing, I mean this is true with kind of most bank financing, but maybe to an extended level with like high yield debt and kind of things of this nature, you have covenants that the company needs to meet. And so like to our cash flow conversations, the creditors expect you to have a certain amount of cash flow and a certain amount of interest coverage and a certain amount of fixed charge coverage and to be able to run the business. And so when you're kind of thinking about the forecast and projecting out where this business can go with incredible changes in revenue and your ability to produce it, you all of a sudden find yourself in a situation where versus being a small business owner without debt where you're essentially saying like I have to make interest payments. And now that becomes a mandatory kind of thing. And of course, you can renegotiate these things and things like that, but there's still a high level of interest payments, particularly in these 10-time debt type situations, which is what I was kind of working in.
It's
Um,
so crazy.
so it becomes you have to get rid of people. You have to get rid of staff.
Yeah.
You have to reduce costs significantly in order to make it. But what's interesting now I'd say, kind of putting on the entrepreneur hat now that I've
Hmm.
been an entrepreneur, what's interesting is that you're essentially, in some respects, kind of cutting off the hand that would continue to feed you, right? Because you're reducing your marketing spend, you're reducing your sales team, you're
Which is
doing
going
all
to
of this.
impact you down the road.
Exactly.
Well, it's very fascinating because with a good chunk of my clients, call it between 10-20 million bucks in revenue up to 50. I've got my largest one that's almost 200 million, but all privately held. That's the commonality. All privately held, and the main constraint that I'm forcing everybody to think about is the owner's distributions of free cash flow outside of their W-2, and treat that like almost like a senior lender dividend and senior lender payment or a dividend that's mandatory. But then you can look at your working capital, debt, and taxes and the constraints. And I've got a lot of people, Candace, that private equity is being suffocated right now around them. and they've done just stupid shit from like reducing pricing, they're trying to buy market share, but because of their debt, their working capital, their interest payments, they can't do it for that much longer. And so I'm starting to watch, first of all, like the services erode to hell. And so now, like privately held business owners, I think are going to have a renaissance because it's
Yeah,
like if they can weather this
yeah,
storm
yeah,
because they don't have
because they
that
have the
suffocation,
flexibility. Mhm,
right?
mhm,
And I have a couple clients now that are looking at like even the ITR economic stuff where like they're not doing really well this year because the M2 money supply growth is softened. But now what they're doing is like they're investing
mhm,
as the PE firms are cutting. And I'm like, this is
mhm,
going to pay off in
mhm.
spades
Dividends.
over the next 18 months.
Mhm. Yeah. No, there's no way around it, but it hampers your flexibility to such a degree. To your point, you are sacrificing your future. But again, remember the cycle is they need to be able to sell to the next fund, right? But so without
Mhm.
that growth story, so it's kind of this it's another hamster wheel.
So how did you, after going through that, like, what are some lessons learned as you were going through the operational thing? And then what was the next stepping stone?
Yeah. So it's interesting. One of my biggest lessons learned, and we've kind of talked about it, was the impact of profitability. Profitability was much more important, obviously, from a PE perspective than it was from a VC perspective. But I did though eventually go into VC, right? And so you kind of
Mhm.
see
Mhm.
the different aspects there. But um that focus on profitability earlier, I think, was a huge, huge lesson for me. And then beyond that, I mean, we obviously had views on the macro environment and kind of where commercial construction was going, but missed it. And so for me, and it's funny, this happened even in my own business, where we kind of missed some of the macro trends as well. Um, but for me, kind of thinking about the downside cases and kind of planning a little bit more around
What happens if this doesn't work?
what if none of my plans work? Then right?
That is, yeah.
Yeah.
Uh, yeah, and we don't have Jay Powell sitting next to us to hit the control P button. So,
Is to just refill the coffers
yeah, just poof, more money. Um,
magically.
so, it's so fascinating. So when before we move on to your VC
Yeah.
exposures, like profitability, just to because these words get all confused. Are you talking gross profit, net income, normalized EBITDA, free cash
Yeah.
flow? Like, what are you talking about?
Yeah. So, interestingly enough, like, again, net income I find to be a very accounting oriented term, so I never talk
Yeah,
about
agreed.
like,
Amen.
yeah, net income
Whatever.
is great. So for me, some mix between, kind of contribution margin,
Mm,
so we'll go a level deeper than gross profit. So some mix between contribution margin, then obviously free cash flow. And their
yeah,
free cash flow
explain
being more
contribution margin.
normalized. Yeah. So gross profit is obviously a very interesting metric in that this is how much you can sell something for, and this is how much it costs me to either produce it or to provide the service for. And that's simplistic. But there's an entire other set of costs, as we all know, kind of associated with either that production or that service that need to be allocated, if you will, to that product. So in one of the businesses that I started was a Pilates studio. So this is how much a membership costs. This is how much it costs me to provide the classes. So that's my gross profit. But I had sales time, I had some marketing expenses, and so an allocation for the cost of those things against the gross profit kind of gets to a real measure of what do I actually have left to think about reinvestment.
It's fantastic. And combination of free cash. I love that because
Yeah.
I think that's why it's so important because people say the word profit and like again with people without finance or accounting degrees it can
Right.
be all blended together.
Yeah.
How, private equity, they need to get their rates of return back to their investors. They're buying cash flowing companies, leveraging them up, hopefully doing these things to sell them, to give them back to the
Mhm.
teachers who need the money for
Who
their
need for their
payments.
pensions, yeah.
Yeah, for their pensions. Venture capital is a different flavor of
Yeah.
the game of capitalism with different goals.
Mhm. Different players,
How did
different goals.
how did you land on that, and how did you decide to go from where all of a sudden you're worried about cash flow to like hell with it. Let's go to
Who
somewhere
cares
that
about
doesn't
cash
care.
flow?
Well, you know what? This is too much work.
Screw cash flow. Yeah, it's so this was so fascinating to me. And I'm again, I knew these things on the surface, but I think it rings differently when it's your day to day and you're in it. It was so fascinating to me how different this was. But so essentially, private equity. I did a stint in general management. So this is when I worked at Raymond James
Okay.
and focused a lot more in like
So that was before the
that was
VC?
before VC. So I
Okay.
I
Okay.
even took it another step further and went far into large corporate settings and, really prioritization of strategy. And it was I mean, it was amazing. The post-MBA program there is essentially you work with, the CEO, the executive chairman, the heads of all the businesses, and you're focused on whatever is strategically important, right, at that point in time, and kind of helping to guide the management team around decisions, strategic decisions. And so, um, allocation of capital at large company was kind of what we learned there. It was amazing. And then from there, I really wanted to, kind of go build something from scratch. And so that's kind of where VC came in. And so I worked at Opendoor. Opendoor is fascinating. Opendoor was, I think, just before C when I joined. And I was there through like a little bit after Opendoor going public. So got to see the full kind of cycle of what you hope happens when you
Like what
kind of
size did the company go from? Like how many employees from like when you
oh,
started to when you
so I think I was roughly 600, like
Okay.
around that number. I mean, Opendoor definitely had 1,000 plus people by the time I left.
Okay.
Mhm,
Oh.
mhm. Um,
And what was like the chatter and the game that was being played inside the doors?
yeah.
No
So
pun intended.
so Opendoor was, again, very, very fascinating from the perspective of, really incredibly smart team, just lots of Ivy League MBAs, um kind of making a lot of decisions together, right? And kind of trying to master this puzzle. It was tough because thin margins, right? You're buying and selling homes with your own capital. So if you don't get the valuation decisions right,
Yep.
that's it, right? Like there's
Yeah.
not any
Yeah.
more margin to play with. And so it's fascinating to see if we could build this model around essentially predicting real estate prices.
So
Yeah.
fascinating.
Yeah.
How was this scratching your itch for like puzzles and problem solving?
I mean, talk about so I managed the Florida region.
Okay.
And so that included renovations professionals, that included pricing professionals, it included like me doing PR with agents in the community and trying to get them to buy into this idea. So Ryan, it's fascinating. So I love this job. It was
Yeah.
fascinating
Yeah.
in so many ways. But scratch the itch from a puzzle perspective because this business model was incredibly hard. So
Mm.
buying a home, I can't tell you the number of homes we bought at the wrong price points, right? And so we just automatically lost money and we were trying to minimize our losses. I can't tell you the number of homes, unfortunately, and obviously we got better over time, but the
Yep.
number of homes that we unfortunately bought with issues, foundation issues, like things that we would have to spend a lot of renovation dollars in order to be able to, eventually flip
Hmm.
homes. Um, Even kind of thinking about down to negotiation tactics with agents and with buyers and what really matters to buyers.
Fascinating.
I mean, it was so incredibly fascinating. But that was kind of the puzzle there was like, how can you make money in the midst of all that? So I would say at Open Door, and this is kind of true of VC, I think in general, we kind of accepted that we had this learning period and that learning period would cost money, right? And so you had to raise in order to continue as a business.
And like is the thesis then we're gonna just break shit, learn, and
Mhm.
then on the on the other side of that, we can generate a what
You
percent
pick up
IRR?
volume, exactly. You pick up
Like what like
volume. Mhm.
and what's like the rate of return that you guys are because like it's interesting because you're a public company,
So we
right?
we
Or you're going
became
or
became a
you're
public
going
company.
right.
Uh-huh.
So this is where I think it's so fascinating because of how many layers gets on top, but the game is the same, which the internal rate of return is the discounted cash flow of the
Exactly.
future
Mhm,
risk of cash flow, of
mhm,
real cash.
mhm.
So you're in the industry that you choose. You're then using all the inefficiencies of the real estate market, like you're talking about, to make money, but then your stock is also public. So you guys have to make money on top of a different asset class. So like you have all this layering, but the name of the game is still the same.
Yeah. No, it's exactly the same. And honestly, it only became that because the other VC-backed companies that I worked with post Opendoor were not yet public. So it's this kind of interesting comparison to how much harder that became once you were a public company, right?
Oh, interesting.
Yeah,
Yeah.
yeah, because we I mean, when we went public, we had figured most of it out, a lot of it out, right? And we could kind of
Hmm.
work in much higher volumes and like Florida, as an example, was a break-even market, and so we knew what we were doing, and
Wild.
so from there, it's just you need the volume, right? And once you have the volume, you can kind of get there. But thinking about how unpredictable that is, which from a public company perspective, you're trying to report these consecutive, kind of quarter over quarter growth stories. That's hard. It's hard.
Oh, it's and it's so fascinating because like you could that could be an argument for like where you see all the people that they don't go public
Right.
anymore for like 10 years, which the
Right.
whole VC model is now different.
Yep.
However, now you have all these bullshit valuation reportings because they're not assessed by anybody. So then you go, okay, like
Right.
all the VC and PE firms are just mark to
You
market.
know.
There's just making shit up. It's like, hey, we're worth this.
Everyone's a
So
unicorn.
I remember, I never forget it. Candace, I was sitting like, because I talk about this stuff all this time. My wife, when we were talking, I'm like, it's just insane. These things, these valuations are total bullshit. Like someone that I know that's very closely related to me works at a VC backed company,
Mhm.
and like we have to make money now. And it's
Yeah,
like, oh my god,
it's
no
different.
shit.
No, it's
Like,
different.
like there's literally no mathematical way your company will ever make the money that
That is
is
neat.
based that it's needed to get the return. Like,
Exactly.
and my wife goes, well, like, wouldn't a company that just burns money like that forever just be a unicorn? And I was like, that's literally why the word came like but if every horse has got a horn with purple wings, it's not
It's
it's not
no
unique.
longer right, you are no longer unique.
I know. Oh my God.
But it's so true. No, even the second VC-backed company that I worked at, so to your point about, kinda thinking about the cash flow, we went from pre-seed to B. I started pre-seed. We went from pre-seed to B, I wanna say right in less than a year.
Oh my gosh.
It was tremendous. It was tremendous. I
R-
mean, we grew talk about needing to, um, kinda think about ways to allocate capital for growth and things like that. My team grew from 6 people, I think, when I started to 60 in less than a
Wow,
year. And so it was
that's a lot.
it's a machine.
Yeah. And trying to keep the operations together while
You're trying to
hitting the
train
goals.
people, understand what you're selling, fine-tune your service or product, get more people on board, have cross-functional,
Mhm.
be functioning from across it's a lot.
Well, and that's where like I think it's so fascinating again, Candace, why like all so like kind of level set us again. So we got private equity firms, there's growth buyouts, or there's minority, but at the end of the day, they're using leverage and debt to buy a cash flowing company to hopefully it was financial engineering. Now it's created more healthy operations.
Yeah,
And but like
run the company.
at the end of the day, it's taking cash flow and creating more cash flow,
Mhm,
hopefully,
mhm,
without all the financial engineering.
mhm.
Then venture capital is do that faster,
Faster,
break
way
break
faster.
shit faster.
Break it every day.
Yep. And the VC firms, it's 1 out of 20-ish or whatever that'll work out. Private equity, it
Mhm.
used to be like what, 4 out of 10 or something like
Yeah,
that.
I
Now
mean,
it's
you had
even
pretty good
lower.
yeah, exactly. You had in the day, you had pretty good odds for making it work in PE because of all the things we
And
said.
I talked to my buddy Nick Bradley. It used to be like he said it used to be 8 out of 10, and now they've inverted it. 8 out of 10 won't work out
Yeah. So looking for the
because now
home
just
runs.
yeah, isn't that crazy? And like just the I know just the destruction to the economy
Yeah.
because like there's necessary allocation for PE and VC, but like it's
Over
overgrown.
indexed.
Eh,
Yeah.
yep, over index. And so I'm kind of level setting us because the name of the game is still free cash flow and the risk of free cash flow. It's just what's
Mhm.
the speed?
Mhm.
Are you reinvesting and raising money to get there faster, or are you using slower growth? I mean, like it's just
Exactly.
different levers to
Mhm.
pull on this.
It's just different mindset for kind of philosophy around how to grow a business. Plus, I guess the other unique aspect would be obviously the innovation, right? For most part, VC um, will be newer product services, newer ways of doing things relative to PE is more doing the existing things better.
Well said. And you, in order to grow that kind of fast, you have to create a new category or a new product or service or
Exactly.
AI, etc. But so I'm going back to then how you're wired, your brain is wired, is trying to predict the future and see puzzles
Yeah.
and stuff like that. So like what have you learned up until this point? Like how have you kind of like
How have I
synthesize how the world
framed
works?
framed
Yeah, like how does it all work? And like what are you then thinking about at this point?
Yeah, that's a great question. So, and I don't think it was clear to me at the time. It became clearer as I kind of moved further away from both of the worlds. But what became clear to me, kind of through these processes, is that there are an incredible number of ways to create value. Um, I lean more towards and hence me becoming an entrepreneur, I lean more towards there are opportunities that are still incredible returns for investors that don't require um business owners slash founders slash entrepreneurs, whichever kind of camp you feel you fit in, which don't require those individuals to sacrifice so much. There's a lot of sacrifice from a people and person perspective in management in both PE and VC. Different sacrifices, I think, to some extent. Some of them overlap, but different sacrifices. But there is an incredible return opportunity for an individual and an investor potentially that doesn't require the same shenanigans, frankly, that happen
Yeah.
within those two worlds. And that is the value creation I wanted to have.
So awesome. So I resonate with you a lot on that. And well, I want you to clarify how, because I've got my definitions of those words, but like, because I like the world is a series of trade offs, right? So like you're figuring out what game, like let me just share with you my articulation of this because I want to hear the why behind your descriptions, Candace. Because if I have to play a game every day, I want more freedom over my time. So like I'm solving freedom over my time and people not telling me what to do. Like that's just been like every like through line of all of my decisions. Like I don't want to be told what to do. And I want to create value and create when I think about creating value, it's like I want to deliver a product or service that makes other people's lives better. And that's how I want to get paid. And while also not being told what to do, while also having freedom over my time, while also having the cash from the equity that all are aligned towards that. And so like then within that, I had to go like you actually went through and like worked in those different industries over the last 10 years. I've had a podcast and had three different like kind of service firms
Yeah.
where I was like, try this on, try that
Let me see
on,
if I like
try
it.
this on. I was like,
Mhm.
I don't like that.
Yeah.
It's kind of like my daughters are like, I don't like T-ball or I
Yeah.
like this. And
Right.
it's just like
Yeah.
I kind of tasted different things to
Yeah.
figure out the alignment.
Mhm.
What is your way of like I mean, because it sounds kind of like that's what you did
Yeah.
too,
No,
is like
exactly.
trying.
That's what I did. Mhm.
Did you do it intentionally? I
I
didn't do it
didn't.
intentionally.
I did not. So it was
Okay.
so funny. I did not whatsoever. I literally at each of these junctures, I had a North Star, right? At each of the kind of career decision points. In the beginning, it was I want to do the hardest thing possible, right? It changed to um I wanna trade some of my time, but I wanna get some of my time back at some point, right?
Uh-huh.
And that was kind of
Uh-huh.
more my general management stretch. And then at some point, it was like, I just wanna grow something, right? And that was my VC stretch, right? So I had different North Stars at different points in time, but it was not whatsoever intentional that it happened this way. I'm glad it did, and it
Mhm.
definitely made me who I am, but it was not whatsoever intentional.
What allowed you, Candace, to change the game or the North Star
Yeah,
each time? And how did you deal with that
yeah.
mentally yourself? And how did that hand I didn't forget you said your husband's an accountant.
Yeah.
So like, how
My
are you
husband's an accountant,
convincing
and I have
him?
4 children, right? So
Yeah. So how are you pulling this
I'm in a
off?
box, right? So to some extent, I have a box. You know what? And he would say this too when he listens to this. He will laugh when we get to this point. Because I can't stay in the box. I can't stay with one idea. I've tried really hard. I can't stay with one idea. I can't stay with one theme. I was just like, I'm just this natural explorer. And I tried to become this specialist, right? I was like, oh, I'm gonna be this like finance specialist and I'll do deals and then I was like, oh, okay. I loved it, but it didn't satisfy the other parts of my life. And so I was like, well, I gotta find something different. My husband's like, well, shouldn't you just stick to it? I'm like, no,
Yeah,
I
yeah, not
don't
really.
have to sacrifice that. I just don't believe that I have to sacrifice these things. And so I'm just crazy enough to believe, honestly. And I wouldn't have said this out loud at the earlier points in my career, but I'm just crazy enough to believe that I can do all these things at the same time, right? And I'm just like looking for the opportunities.
What are these things?
These
Okay.
things, yes. Okay, so you're my current, these will change, Ryan. So
Yep.
these are
Yeah.
my current North Stars are
North Stars. So
what like multiple.
Yeah. Okay, if there's a camel and we're going somewhere, which North Star are we?
Like, which hump are we sitting on?
That's awesome.
So they are a fair bit of time allocation. I like my time. And so I gave so much of my time freely in the early parts of my career. Because like, as you know, I did things that required me to work 80 plus hours a week. And I did not have free time. I sacrificed a ton of my self-care to do it. And, kind of other things. I found out I had an autoimmune disease in the middle of that. So like, right, like there was a lot going on in my life. But I was okay with sacrificing it. And I would, again, honestly, do it again all day long. But time has become a lot more important to me, particularly as, like I said, I have 4 kids. So as my kids get older, and I'm just, I'm in this realization, honestly, Ryan, that one, my mom's getting older. And so like life has finality to it more than I ever felt it did when I was younger. And, um, and not only that, there's only enjoyment is really important to me, and there's only so much sacrifice of enjoyment that I can make, and that is extremely important to me now more than it was then. So that's 1.
Hmm.
2
Which
is
enjoyment has to do with your time and
my
the freedom
time.
that you have over. Yep.
Exactly.
Yep. Yep.
Mhm. Um, 2 is that I've been very fortunate from a career perspective with the opportunities that I've had, and I have a certain level of, let's just say, like a certain level of wealth that I have in mind that I can achieve, and I still want to achieve it, even though I have this time constraint, if you
Okay.
will.
Yep. So have you seen my flywheel,
Yes,
Candace?
I know.
Okay.
But when I saw it, I was like, "This is me. This is the framework."
Oh, I was gonna say that's fantastic. Because like where you said wealth
Yeah,
and wealth being equity and assets,
yeah,
but there's that component of cash flow, which becomes like those are the trade-offs where
yeah.
like you ever read the book The Goal?
I haven't.
The Goal with
Oh,
you.
I gotta read
Oh, it's yeah,
the goal.
it's like a 1980s book, and it's all about the theory of constraints.
Oh,
And it's all about this guy who went in and he turns around manufacturing plants. And it's all about opening up the bottleneck. And the entire point is just open up the bottleneck. Always focus on the bottleneck and open it up. But you have to understand the first principles of constraints. And that's where I landed on the time, the cash flow, and the wealth. Because if we want more time back, we can only make so much cash flow and wealth. And the trade-off of like, if we take more cash flow today, we're stealing from the wealth
from
from
the future.
tomorrow.
Mhm.
So like, it's like these are the like,
Yeah,
so how do you solve then? So you've got this idea of wealth.
yeah.
Then how are you delegate or dancing around or optimizing the cash flow and those trade-offs of those 3?
Yeah. Yeah, so that's where I've been doing a lot of experimenting more recently. And so it's kind of a combo of things. So entrepreneurs, so we have, some small businesses that we own.
Give some context there, because you scaled the business really fast and learned a lot of really hard. You were almost like in VC and you didn't even right. So
this tiny thing happened. So our very first business, my husband and I, So we were both still working full time. I don't know if I told you this part. We were both still working full time. And I was actually on mat leave with our fourth baby. And we were kind of out and about. I think we were having lunch with her. And I just noticed all these people were just out and about enjoyment, enjoying their lives. They're just sitting around having lunch. And I'm like, well, if I were not on mat leave right now, I would be in an office and I would be working. And not that that's not enjoyable to some extent, but that's what I would be doing if
Yeah.
I were not on mat leave right now. And so
Not hanging out at 2 in the afternoon while people are just out and about.
no, no, not at all. I didn't even know what that like, you could do that? You could like, in the middle of the day? And so I started we both, separately kinda started having conversations with people like, "What do you do, that allows you to, have
So
lunch at
awesome.
2 p.m. and you're not sitting in an office?" And, of course, they were entrepreneurs and many different flavors of entrepreneurs, and so we started having conversations with business brokers. We're like, "Okay, we're gonna buy a business, and that'll create." I'm very big on, like, having the foundation and then playing, like, above my foundation. So, again, back to the
Yeah.
cash flow, like, I need my foundation because I have a
Yeah.
life, and I'd like to live it in a certain way. But then I can play, kind of above
Oh,
the,
that's so awesome.
foundation. And so we were like, "Oh, well, maybe instead of our foundation being W-2 situations, maybe it's this business that we can buy." And, so I don't know, probably for 6 months or so, talked to a bunch of business brokers, and honestly, Ryan, I had such a hard time, and you talk about this a fair bit, but I had such a hard time with valuation. It's like, "I'm not paying you that much for that company. It's not worth that." And
Wait a second. I'm going to mortgage my house, my 401k,
right.
and buy your job?
Right. I'm not that
Wait,
does
what?
not sound like I'm gonna be sitting in the cafe at 2 p.m. And so I don't wanna do that. So we at some point abandoned the idea. Now I do wanna revisit the acquisition kind of idea, and we
Yep.
talked about
Yeah,
this,
I like that.
but we abandoned, the acquisition idea because of this. But a lot of the businesses, for some reason, a lot of the businesses that we kind of did diligence on were healthcare oriented. Neither of us have a background in healthcare. They were healthcare oriented, and they were different flavors. Just like there was some home health businesses. It was just like different flavors all around.
Assisted living, different random stuff.
Exactly.
Yeah.
And
Yep.
so again, in those conversations, we met a couple of attorneys who kind of focused in, kind of businesses. They were, representing businesses in this space, and consultants, again, it was just a bunch of networking. And so we eventually met this consultant who she was like, "Well, I can help you start one of those if you want me to." I'm like, "Oh, okay," because I have some business expertise. Sydney's the accountant, right? Like he has he has that piece of it. Um, and we'll just start our own. And honestly, it never occurred to me that would be much harder than buying. Like, it just never occurred to me at that point in time.
Yeah, right?
Right?
Yeah.
Again, back to my puzzle pieces. I'm like, "Okay, so
This
those
is a puzzle piece I haven't seen yet. Let's
haven't seen this
see what it
one.
looks
So
like.
let's figure it out." And the other ones are too expensive. Like, I'm not paying for that. So I'll just
Yep.
make it
Yep.
myself, and I'll keep my job full time. So we both have full time jobs.
Well, on my 4th child.
Okay,
Yeah.
and I have my fourth baby.
Yeah.
So
All
so this
wait, 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 wait. Have you really we talked about this constraint called time.
that
Yeah,
came
like what
later.
we
That came
yeah, I got it. I got it.
that came
Yeah. Yeah. Denial
Yeah,
is a powerful tool.
Yeah.
Oh, that's awesome.
That's so true. So that's what we did. So we started our business in the evenings at night, and it grew. We both still have full-time jobs. It grew from 0 to 10 million in revenue in 2 years, and we both still have full-time jobs. And so then at some point, we were like, one of us should quit. And like,
Like, what are we doing here? 'Cause, like, did you make any, because you had to have been piling every dollar back into the company at that.
Yeah.
Yeah. So it's like going back to the time, cash flow, or wealth trade-offs. It's like, well, definitely don't have more time.
No more time.
Cash flow is like evaporating as we're piling in. Like
Yeah. But
the
wealth was building because I had a theory
mm,
that we could have a tech-enabled healthcare service, and so
okay.
that's what we reinvested in, technology.
Well, and like, okay, so I want to take a pause here for a second because, like, I think I've had a hard time, Candace, before my framework of explaining. So of my 3 phases of towards the escape velocity, decoupling your time from your cash flow while the wealth is growing without you having to do it all. The first phase is the plan phase, and it's can you picture like a fractal and a Fibonacci sequence where like it shoots up forward, where like the inception is taking the ownership red pill. And we talked about it on the panel yesterday, and we will get to our opinions about how that went, because I got some interesting conversations I want to have with you on that. But we have to understand how valuations work, because we can't see the trade-offs. Like I could see it in how you just said it. Like our thesis was we're going to create equity, but instead of, when I talk to other people, they're like, I hope to shit that this is going to
I hope
work,
this
but like
reinvestment works out,
no
right? Yeah.
idea how valuations work. But
Yeah.
you came at this going, I understand, hypergrowth VC. I understand private equity. I understand strategy. Like I have a finance background where the goal is to create rates of return. You intentionally forwent the cash flow
today.
and sacrifice the time for the wealth accretion. So like, I just wanted to highlight how important your education and understanding to make that bet.
Yeah.
It was a thoughtful bet.
Yeah.
Whether it works or not is a
Exactly.
whole different situation.
And you have to decouple the two, right? The decision-making process was solid.
Yeah, that
The
is
result may not have lived up to
Oh, that's so good. Because like right when you think about it, like how many people do you know that like they're just hoping it all works out?
Yeah. So many.
So you hoped
Yeah.
that it was gonna work out,
Oh.
even though the decision-making process was still sound. So like,
Exactly.
so your thought was that we're gonna pile this all back in
Yeah.
and create equity and create value. So like, how did that impact your decision-making of what to do in the business and how to go from 0 to 10 million?
Yeah. So, so initially it went to, because remember we both still have full-time jobs. So initially it went to staff, right? So we just needed people to be
Yeah.
able to answer the phones during the day because we couldn't.
And what was the business actually doing?
Yeah,
Like what was
so
the
it's funny, we pivoted, so we started home health, quickly pivoted there for a variety of reasons, mostly regulatory related, and we went to nurse staffing, and so we staffed into assisted living facilities, rehab facilities, some hospitals, things like that, but this was COVID, so my timing again was very perfect, very analogous with investment banking and private equity, so there was a shortage of nurses, so we were able to charge premium pricing because of that. Oh, right. So I don't wanna say this nonchalantly because it was definitely hard, but that was the easy part. We actually because of our kind of business backgrounds, we created this non-technology it wasn't technologized on the back end, it was very manual on the back end, but felt technologized to everyone else. Essentially like recruiting platform on the back end, and so we had people. We had plenty of people. That was n what the harder issue was just when we started hiring, with sales. Like we had to go find the facilities because we had so many people, but not we didn't have
Oh,
facilities.
fascinating.
Mhm.
Fascinating. So you said your thesis
So the
was to
thesis
grow
was
to grow equity. So what were the valuation metrics that you were using?
yeah,
What how were you judging that? And like what kind of data did you have, like a 3-statement forecast where you were like projecting this stuff out?
yeah, like
You say
you
absolutely,
got
like,
the
oh, of
accountant.
course, Ryan.
You got the accountant and the finance person. We like over modeled maybe.
Like who are we pitching this to?
Right,
Ourselves or to an
like, is it the
investor or a
investor
banker?
deck? It's just right.
Is this to make sure that we believe our own bullshit? Is
Right.
like
Well, some of it was, right?
Oh, that's awesome.
So
Oh.
yeah, so we had that from go. Now what I will say, and I'm sure you experienced this with some of your clients, like your emotional, it's your baby in some respects, especially because this was our first business. And so, I put together a lot of upside cases when I was in banking. Nobody was really thinking about the downside cases. And so like, yes, we had them, but we did not predict that our downside would be quite as drastic as our downside was. And so that's why I said like even the best laid
Mhm.
plan is still unpredictable, right? But we figured it
What were your thesis or assumptions that did not pan out the way you thought?
was the macro. So we were COVID boosted, right? And our COVID rate come down was faster than we expected.
Oh,
So that was part of it. And then I think the other, we again, you have the accountant and the finance person. So we were, we had lots of risk models, right? So we did think about downside. We just didn't think it would go quite that low.
yeah.
But the other risk model that we took a bet on, honestly, was um customer concentration. And there was one particular customer that we had a really great relationship with. They were a great payer until they weren't, right? And so
Oh,
we got
yeah.
caught with a seven-figure invoice, which we are currently still litigating. Um,
Oh, yuck.
yeah. So that
Yeah.
was more it. But, and I've learned to separate the decision-making process from the result. I'm like, I still would
Mhm.
have made the same decision all day long because they have been a good player, and we were obviously diversifying as quickly as we could, hence hiring staff and, additional
Mhm.
salespeople, etcetera. Um, but bad actors,
They show up.
they show up.
Well, and, like, what I learned the hard way and over time to do what you're doing, and that's kinda like what we're talking about is at the essence of my playbook and my material, and, like, why I built this framework and think this way, Candace, because I just wanna look in the mirror and be like, "I tried." And, like, not wanna kill myself with resentment to myself and all that, like, we're I love how clearly you said, like, "I tried to do these things. I like, the decision making was sound, there was variables you couldn't account for," and I think that that's okay, and it takes some of the emotion out of it. I over the years I've read, and I don't know if you probably have Ray Dalio's like decision making and the principles. It's like, okay, we're not gonna we're trying to increase the probability we make the right bet. We still don't know if we are, but then if we can understand the implications of our time, cash flow, wealth goals,
Mhm.
we can still keep this alignment and still be more sane
Right.
and happy along the
Right.
process.
Exactly. And that it's hard. It is incredibly difficult. And I mean, I've talked to other small business owners who, even if it wasn't the same magnitude of the invoice, you get caught with an invoice or you get caught with some situation that you just, kind of weren't expecting. And yeah, I mean, even for us, my first instinct was just like, man, I could have made a better decision. I shouldn't have taken that risk. I should, and you can emotionally attack yourself.
Torture yourself. Yeah.
Exactly.
Yeah.
And
Yeah.
it took a lot to come to the point of no, like let's think about the circumstances that led up to this point. And I'm like, I still would have made that same decision. It was a risk reward trade-off. And unfortunately, it fell the other way.
Yeah.
But the next time it
And
won't.
yeah, and so you could still have the business then?
So that particular business, we're doing less and less, because we have two other ones now. So it didn't stop me from being an entrepreneur.
I just keep going, just turn around. All I can picture is that it's like those game shows where they're swooping in and out and they're getting hit with shit and like they're jumping over stuff and they're like
It's
it's
like the
like
obstacle course.
welcome to yeah. Well, and I think the obstacle course is the point, and I think it's like as we keep our time, cash, and wealth goals aligned and in sight, then we're just saying like this is just the game and the landscape that we want to play the game in. What there's so many good points to this. Like going back, you said go back to the acquisition entrepreneur and the price to pay and stuff like that. And I don't know if this is a good launching point, but like I think that like the mission that I've been on, Candace, is like it's the lack of understanding that then makes people guess on the decisions, which means there's a lack of realistic expectations. Lack of realistic expectations leads to resentment, unhappiness, anxiety, which makes the journey even more difficult. And like all these different, like all like it's kind of like the way I've described it, it's like a exponential flywheel up or exponential flywheel down, and there's not really an in between, and it's emotional and financial and everything. So um what is your experience like when you're going through the acquisition entrepreneur, or like when you're kind of dabbling in that space? What's your like take on the state of the marketplace and like what's currently going on?
Yeah. So I know we shared a little bit about some of this on our panel. Um, I will maintain that there are indeed good opportunities that exist, and define good. Somewhat loosely, but meaning that um, there are businesses that potential buyers are willing to own at, you know, a price point, an acquisition price that makes sense, a valuation that makes sense to them. I do think that, and we've talked a little bit about this too. I do think that creativity is more important today, than perhaps it was in the past. So again, kinda comparing to my PE time where creative structures at that point in time was, like, more leverage, right? Like, how do we get more leverage?
Yeah, you're talking about deal structures, creative deal structures. Yep. Yep.
Exactly. But it wasn't, um, creative acquisition structures, let's say.
Hmm.
But I think that there are more and more buyers, potential buyers in the market today for a number of reasons. A lot of people looking for that time freedom. A lot of people have been laid off. We know that this is when, acquisition or sorry, when entrepreneurial opportunities are made, right? And like in times of these significant layoffs. And so I think there are more and more folks in the market. Um, there should be more and more assets to buy, but maybe not yet, right? This is the great tsunami that hopefully comes. We'll see, right? Um, but that means that you have to get more creative to make it work. And one of the things that I mentioned in that panel was that I think it becomes, and this is something that I'm considering for myself, I think it becomes a potentially unique situation where you're building portfolios, not necessarily PE style funds, right? But you build portfolios of smaller companies potentially because those are the ones that are available to transact in with, larger quantities, frankly.
So I love this. This is a good foundation to. You got another like half hour. Okay, let's because now that we've covered we've synthesized and kind of danced and gotten in sync with the dance of our understanding of like the topics, the markets, all that kind of stuff. I think it's very helpful if the listeners are still along for the journey, is then understanding like where's this going? Where's the current market? And like so um let's talk about a couple of things, because like that panel got a little
It
spicy.
did get spicy. I liked it.
Yeah, I know, because I think it's a bunch of bullshit. Like this whole exit planning, like and like I'll be like, we're gonna do a round two. I think Graham
Yeah.
and Kyle are gonna facilitate a round two. I said, I need 3 hours.
Yeah.
I'm not gonna
Like
do. I'm
that.
not. Because we're gonna have to cover a lot of ground to get on the same page with how we're talking about. So,
Yeah.
um, some of the things in no particular order, and I want your thoughts. I'll volley some stuff over there. So the U.S. Census Bureau, and I'll just kind of give you the broad brushstrokes of like, okay, what is the current economy? And I think I said this with or the current demographics with Elliot, or who introduced us. 27 million companies, 6 million of them have employees. They employ 130, 140 million Americans, which is over half the workforce. It's like 2/3 of the workforce. Only 21 million or 21,000 of them are over 100 million. They employ 60 million Americans. So then there's the 5 million to 100 million, which they define as loosely the lower to middle market. And they employ there are 350,000 companies that employ 35 million Americans, which ends up being like only 4.5% of companies are above 5 million in revenue.
Right.
And over 100 million is like 0.5.
Is almost
Like,
non-existent.
yeah, and everybody's like, I want to be $100 million
Right.
company. I'm like, yeah, good for you.
Right.
It's like for the people that are, and I
Probability.
truly mean it. Like, but again,
Yeah.
I'm not running an Ironman. There are people that do.
Right.
So then that means that most of the people are underneath 5 million in revenue.
Mhm.
And then if you took the Pareto principle on that, you go, most of them are $1 million. Like that's what that Mike was saying,
Yep.
is like they're mainly 100 or $1 million.
Yep.
The average age of these people, of the boomers, is 65, 66 now.
Mhm.
this is where my whole conundrum I talk about, Candace, of there's the job versus the asset. And unfortunately, we have millions of people that went to work every day that have a job with like 15 assistants.
Yes.
And there's this assumption that it's a company that can, but like, and I don't say that because I've had a couple of those, by the way. I
No,
started a
exactly.
couple,
Yeah.
and I was just like, I got out of the
Yeah.
last one, and I was just like, I can't see the other side of the chasm
Mhm.
for the investment of cash flow and the equity return while working.
Mhm.
And so I decided to back out of that. But I
Mhm.
think about, because it hit 7 figures and there's not enough cash flow to finance that thing
Yes.
while the person also like there's just all these constraints of the labor, the person's needs for the retirement, and like there's just so many people stuck. So I don't think there is a tsunami,
Mhm.
unfortunately.
Mhm.
And like, because you've looked through a lot of these, what is your thoughts on that?
Yeah.
Because you have the, yeah, what are your thoughts?
Yeah. No, it's fascinating, right? Because to your point, if you think about the structuring that needs to take place in these,
Mm-hmm.
kind of sub-$1 million categories with SBA, and we talked about this with SBA,
Mm-hmm.
it's and cash flow is one of your North Star, right? It's hard to pencil out any of those situations in many respects to depending on what your cash flow parameters are, right? So like everybody's going to have a different one.
But like,
But
let's take
but
time, cash flow, and
just
wealth, and just
run through
actually run. Yeah, let's just like run through it. So, okay, so you said you want to be at the cafe at 2, and it's like, oh,
it.
by the way, you're gonna buy this plumbing business or healthcare business, and you're gonna work 70. So you're gonna as an through the lens of the acquirer,
Right.
you're gonna take on a new job that's working 70 hours
Yep.
while financing an SBA loan that's a couple $1,000,000 that's
That you're
got your mortgage in your
personally
in your
guaranteed
401k.
for.
Yeah. You have no cash flow to reinvest for growth,
Right.
and the wealth you hope is going to
Ex
come because you've got no ability to reinvest.
exact there's nothing to reinvest.
So
So
which
how does it
like
work?
the point of the
Yeah.
one of those is supposed to
Well,
overcome
somebody
the
has
other
to give,
two.
right? Yeah. So I and this is where I'm being very deliberate and slow, honestly, and kind of thinking about what strategy I want to pursue. For me, it has to eliminate the SBA. And I know that that
Mhm.
is, contrarian to how
Well,
most
they've
people.
got more rules coming out every day,
Yeah.
and
I was like, the SBA just doesn't work, in these scenarios. It works at, I think, a different threshold,
yep.
perhaps, if you're willing to take the personal guarantee. There are a lot of risks with that personal guarantee that I think people don't size. Like, are you
Which
really
increases your cost of capital, which actually decreases your rate of return based
exactly.
on the. I mean, like there's all
Yeah.
these. Yeah, yeah.
Yeah. So I think that there, and I don't know what it is yet, Ryan. So maybe you can help me with this. But I
Well,
think
it
that
can
there's
convey. Go ahead.
I just think that there's some other creative financing structure. Perhaps it's and I think differently again about this because of my background, but
Hmm.
perhaps it's some holdco level um, where the owners are retaining more of the company, right? They get some level of cash out, but they, kind of have these minority stakes into some level of perpetuity for a period of time. But I think that it has to be a more creative acquisition structuring to make it work. Because for me, it's not with the SBA.
Right. So let's talk about like both the buyer and the seller thought processes
Hmm.
on this, because like the definition of a fair exchange is that both people
Has
saw,
to
like,
be
I'm trading my equity in this
exactly
thing, you're going to be buying it, where like,
right,
so in order to avoid the SBA loans, there's like, okay, what are the different ways to do this?
right,
Seller financing, and then the seller's going F off. I might as well keep the company. Well, that doesn't work,
yeah,
except in a couple
yeah,
situations where they feel like you could. Yeah, I mean, but then they might. I mean, if it was one of my clients, I'm saying we're coming after a personal guarantee, Candace, and you're
right,
going, I don't want a personal guarantee, but you
right,
might as well do that.
right,
So
no,
like, and
exactly,
it's like, so
exactly,
you get to there's a whole conundrum of like, okay, seller finance. Like, if the seller wants some cash or a disproportionate amount of cash at closing, you're gonna have to come up with cash or debt. And it's like, okay, well, if you come up with more cash, you're gonna need a higher rate of return, and you're gonna go, that's the stupidest use of. put it in the effing Bitcoin and get a 30% CAGR. And then you're just like, okay. So you start to go to this, like, the markets are so inefficient and so, like, there's just been a wrench thrown through everything over the last few years for the financial models that you and I are talking about, Candace. And so, not seller financing, conventional loans, you're sitting there going, well, you need like $3 to $5 million of conventional loan for a bank to be interested in you. And then you're sitting at a 5 to 7 year AM schedule that's going to suffocate the debt. And you're talking, or what are you sitting there then at a $400,000 a month? It would be 400 grand a month. What would you be sitting at? Probably like 100 grand a month in debt service.
Oh, easily like seven.
And like,
Yeah, I was
probably a couple hundred grand.
Yeah. Yeah.
Yeah.
Yeah.
Yeah. So, because you're talking 5 years, 60 months, $5 million. I mean, it's like, so you start to go like, okay, well, that doesn't work.
That doesn't work either.
Then you go, okay, well, so I'm tracking you. Then you go Holdco. So I won't do it right now for you and the listener's sake, but I was on the way to a board meeting. I think I might have told you this. I was on the way to a board meeting in Sioux Falls. And so for 4 hours, I was in the car and I had GPT on voice mode and I built an entire PE fund business model. Okay. So here's maybe the thread that you could pull. So if you're familiar with Michael Saylor, MicroStrategies, so he's putting Bitcoin on the balance sheet, and a lot of companies are now, because Bitcoin can now is now the risk-free hurdle rate. So if that's the case in the DCF, that the risk-free hurdle rate is the new free, the risk-free rate, and you're putting it on the balance sheet as a nuclear engine for your asset growth. So I was like, okay, but I still, like, if we hypothetically still wanted to be in private equity.
Right.
Okay. So I'm just going to go straight geeky. Okay, and if everybody listening in, God forbid, you can just hit off and but I'm going to now use all of the words that are actually like Candace will understand. So here's what the model I ran. What if we raised a $25 million fund? Okay. From investors who also like private equity because they understand the asset class, but also understand that the dollar is at risk because we're getting debased at 5% or 8% a year with M2 money supply. So we can't, like, because going and raising the money from just fiat investors, they don't understand the game of fiat. They're just trying to get whatever 10% rate of return, which is a stupid game, and they should rethink that. So then you go, okay, we need a certain rate of return to overcome the inflation. So if we raise 25 million bucks, let's say we put $5 million on the general partners level in Bitcoin. So we have 20% in Bitcoin. So then what we do is we take the other $20 million. So there's an assumption that that $5 million bucks, it's a 30% CAGR every year, is what Bitcoin has been averaging. It's actually been averaging 50 to 60, but it's going to slow as the volatility gets peeled out of it. It's going to go down to about 30 to 20. So $5 million at a 30% CAGR always sits on the balance sheet, because our goal is to raise the money to get around 18% rate of return, which is realistic. Private equity, 18 to 20% IRR. Otherwise, go put it in Bitcoin, actually. But let's assume they want to put it in private equity. We take the 20 million bucks, then we say, okay, well, we want to go to $1 million to $2 million normalized EBITDA, which we both know is not free cash flow. So then I took some assumptions, Candace, to say, okay, well, we want 13 to 15% of revenue and working capital. We're going to buy out 60% of the company. It's going to be, of the 60% of the company, we're going to do 60% cash at closing, 40% seller's note and debt. Yep. They could take some of that cash, put it into the fund where they're, yep. So they can actually get part. So then they're getting Bitcoin, 20% Bitcoin exposure, as well as the other privately held business owner exposure. And then I've made some assumptions on, okay, if we bought 10 companies over 4 years with the 60-40, how would the deal structure? We have enough free cash flow. Then at the end, what we would do with the first company, once we get to a certain size, and I have this all in the model, we would do an ESOP. Because you can, as long as the IRR is there, you can prove to the bankers it's a guaranteed sale. And then you go, okay, well, on the ESOP, then you could do with an ESOP full transaction, you could do you could actually rebuy out the general partner, the 60% and the 40% of
and
the
the 40.
owners.
Okay.
Yeah. So you do a full
Okay.
recap
Yep.
to do a full ESOP.
Yep.
You can actually then take the ESOP. So let's say that's a $10 million sale.
Yep.
I'm just making it for easy numbers.
Yep.
You can allocate that $10 million purchase price for the ESOP, 50% cash at closing, 25% in mezz financing rates, and then they call it 10 to 20% in warrants, which is like a stock option.
Mm-hmm.
You can allocate that across all the investors in whatever way you want. So then you could actually offer up flavors of equity, of a buyout to, like, you want some cash, you want some seller financing which is pre-tax, so you get an 11% pre-tax, or you want more rolled equity, you can then pull it back in. It's a complete flywheel. All of this shit has to be done perfectly, literally perfectly, to get an 18% to get to an 18% IRR.
Yeah.
So, and I even went through and said, okay, we're going to keep stacking Bitcoin. So we're going to do a sweep over normalized working capital while we're growing these companies. And then that sweep will always go 20% Bitcoin, 20% reinvestment to accelerate the ability to acquire. And then when we do the transactions of the ESOPs, we're going to have some assumptions that a third of the cash goes back into a dry powder to reinvest for growth. And then we're going to stack 20% Bitcoin. And it's this perfect flywheel. And that only generates 18% rate of return with a 30% CAGR of Bitcoin assumptions, which is lower than the 50%. And it's everything going perfectly. I'm like, this is effing insane. How much work and engineering?
Yeah.
Go put it into Bitcoin. What the fuck?
And then you get your time back.
And you don't have to do any of that. And so what's so fascinating to me is I spent 4 hours with GPT running IRRs on the general partnership level.
Yeah.
I was looking at the seller. The seller wants X amount of cash at closing. It has to meet the seller's goals, the legacy goals, the deal structure goals. Yeah. And I went through okay, and that was I think I even did it with a 10-year AM schedule, assuming that we could potentially raise debt with, how Michael Saylor's got Strife, Strike, all the different convertible bonds. Let's assume we could bypass the banks and actually raise debt based on Bitcoin. Just right? Because it's just what Michael Saylor's proven all this stuff. He's got a product now for everything. Yeah. And I'm going it literally has to be financial engineered to this level to just get an 18% IRR. Yeah. And you go, if that's the case, what are all of these funds and people doing? They're all fucking lying to themselves.
Yeah. This is so fascinating,
right? Because I went through that, and why I wanted and I'm so grateful, Candace, for you to just listen to me, is because I have to talk to robots to get all of my ideas across because no one's willing to listen to me for 4 hours. And I'm going I have tried everything to figure out how to spend my time and money in an appropriate place where I feel like I can win without the debasement of the dollar stealing all of my life. And I'm going there's nowhere to effing hide.
This is so fascinating. Okay, so one, we gotta look at this model.
Isn't this? It's fascinating. And I'll help you do it. I just don't. After all that, I'm that could be an interesting game for someone to play, but I don't want to do that because that seems like a lot of work.
Yeah, it does seem like a lot of work. And I'd have to see the model. One thought that I had, I don't know, I'd have to see it. One thought that I had was, could there be some level of contribution of the of the companies, the assets, from a seller perspective to the same fund, and maybe
that's what I was doing. Yeah, a third of it.
Okay.
And then we would split that third, 20% Bitcoin, rest dry powder to accelerate acquisitions.
Okay.
And you don't want to put too much equity down,
right?
Because then it dilutes it. And then the only other way to get a good AM schedule would be to have a 10-year note instead of a 7-year. Yeah. And the only way to get a 10-year note without the SBA loan would be to actually raise actual debt backed by Bitcoin, just like Michael Saylor's doing. Right. So I'm not saying that I'm not saying that I thought of everything, but like I've tried to go like, because I'm coming at this whole thing, Candace, like what should we all be
What
spending
should
our
we
time
invest?
doing?
Exactly. Yeah.
What should we be spending our time doing? And like where I think is fascinating with where this is like, and I think I'll just tell you my opinion because like I think we built a good enough goodwill here where like where I've landed on is optimize the time, optimize the cash flow, and stack Bitcoin.
That's what that conclusion would lead to.
And so what's fascinating to that end is and I'm not saying that this is financial advice or this is, I have been trying to poke holes in my thesis now for like 11 years now.
Yeah.
And it's like, okay, well, and this Bitcoin base layer has changed the game significantly because it inverts the entire, like Michael Saylor on a podcast last week, he literally had a 20-minute rant how all corporate finance is completely effed. And all of the equations for the last 40 years are wrong now. And so now think about this, Candace, if this is potentially true,
right,
then getting a bag, if you're the seller, getting a bag full of fiat shit is the stupidest thing you would do. Because then you're buying Costco at 55 PE ratio. Bonds are all garbage. And then they go back, what would be really nice is if I bought a commercial cleaning company that kicked off $1 million in cash without my job. It's like, oh, how about that shit? And it's like, and then it's like, so like if we can get our time and our income needs met.
Exactly.
And then so like the difference between like a public company like Michael Saylor or like GameStop or you name all these organizations that are now doing it, they're now just doing it because they cannot overcome the hurdle rate. And so now they're just saying, well, we can take the pressure valve down off of the growth rate.
Well, it becomes rational, right? Like then you're just making rational decisions.
And it should have to get a return, not fake assumptions.
Right.
And so what's fascinating about this idea then, these people with $1 million companies that are making 250 don't reinvest for growth, reinvest for time back while collecting 300 grand and quit trying to figure out how to, because like
make it big.
that person would have to grow their company from $1 million to 10 million in revenue, which you and I both know. I was doing 20 million. We had not a pot to piss in for cash flow.
Right.
So like, it doesn't even mean it's like sellable to someone with the cash flow financing and the deal structure and everything. So I'm saying all this because like I literally get lost in my head because like I think about this stuff all day long. And I just think that most people are operating in a game with the wrong rules and the wrong assumptions.
Yeah. Okay. So I want to see the model. I'm like, we gotta talk through this model. I am fascinated. And I agree. Like this is like, again, I was trying to come at it from the perspective of these are the greatest number of assets available and how can you transact at this point and have it all make sense. And like I said, I've been going round and round about it from like, how can we creatively make this happen in a way that satisfies from a return perspective for both the potential investor, but then also from a time perspective, because you're right. No one, generally speaking, wants to buy a job. And have thought about, to your point, some kind of creative contribution models, potentially, right, from a seller's perspective.
And then operationally, you would need to like centralize accounting, centralize HR, and like it's all the bullshit that every investor says they're doing that we all know that they're not. But like actually operationally centralize accounting, finance, HR in a way that actually enhances culture and stuff like that. Because you'd have to have the economies of scale. Back to your original point like an hour and a half ago is contribution margin has to be real. It can't be fake.
Right. Exactly. But
I know
the layer on top of that you are bringing, which I love, I'm fascinated by, is the rationality piece. There is, even if there's a way to do it, is that the most rational way to make your trade-off?
I don't want to work that hard.
Yeah.
Like I'm sitting here going like it's insane. Like I watched a guy, put in $10 million into this business private debt financing for like 11% locked up for 10 years. I'm like, you're an effing idiot. After tax, you're talking what, 8? And that's exactly par with M2 money supply growth. So like you literally are locking up your money and all of the risks associated with random people doing random things and all the economic stuff just to keep par value. And like, this is how I landed on Bitcoin, Candace, because I'm sitting here going, there's no other way out. You're like the treadmill is up on like volume or level 11 right now. And like, we have to literally grow at 11%, which is the cost of capital, which is the S&P 500, pre-tax. And there's only 5 companies that have superseded the hurdle rate and gone above and beyond that dollar amount. And then what does Microsoft do and Coca-Cola? They export their dividends back to us. So they're getting rid of their equity or buying back their stocks because they don't know what to do with the money. So I know, like, to most people who don't usually follow this whole train of thought, it's like we literally end up, it's like we end up, for the listeners, I'm going back in a circle. Like we start here, we go through all this train of thought, and we go back to how do we optimize our time and our cash flow?
Yep. Back to the triangle.
Yeah. It's like, okay, I don't know. I'm trying every way to think about like how I could be thinking about this wrong.
Right. Well, that's why I want to see the model.
So what does, I already borrowed too much of your time here. What are your, if you were to go back to yourself when you're in college and say, hey, you should know this.
Yeah. Ooh.
What would you have said to yourself?
What would I tell young Candace? Well, I hope she stays idealistic. And it's a journey to stay idealistic, as we've seen, but I'd say take some of my risks earlier. I waited, and for a number of reasons, and I think they ended up being great bets for a number of reasons. But I would potentially take some of them earlier, take those lessons and experiences earlier to then be at the point of freedom as defined sooner. So that's one. And then I said it earlier.
How as defined? So how is defined? Sorry,
So
keep that
freedom,
thought.
I think for me it's different, right? But I think it definitely has to be specific to the individual. But for me, it's like again, I want to be in that cafe at 2. I really do. And not even that it has to be the cafe, but it's just I don't know, there's just like fun things to do and experience. And some of that's business related, some of it's not, but I just want the freedom to be able to explore, really. So that's one. 2 is I was so in the weeds with deals and like working my 80 hours and like things like that that it didn't occur to me I had the foundation, but to start building on top of my foundation earlier. I definitely would have done that earlier, in hindsight. And then 3, I think it's, kind of what we said earlier, which is the best laid plans, may go awry. You gotta
What if my
roll with
plans don't
it.
work?
You gotta roll with it. And it's really more of the name of the game is to keep going, more than anything else, which, is a learned lesson for sure.
That's so good. What are you most excited about?
Oh, I am excited about well, I told you I can't be contained, right, in a box.
I love it so much.
I just can't. So I'm excited. I'm rethinking my foundation, right, at the moment. So like we have the business ideas and certainly the acquisition ideas and things like that, but I think of those as like above the foundation. I've been kind of rethinking the foundation. I've been doing some kind of consulting and advisory work, which has been so much fun with small business owners and kind of not necessarily exploring all of these angles, but really kind of getting the foundation down of like, okay, you make this much money, you spend this much, therefore you have this much in free cash flow, and then you can think about what you do with your free cash flow, like kind of that
Mhm.
foundation at its simplistic basis, um, what I've been working on from a foundations perspective. So I'm just, like, switching up my foundation a little bit and doing a little bit more of that.
Oh, that's awesome. We are going to figure out how to explore because I just launched last week in my group program the three statement financial model template that Pat, my old partner, had created.
Yeah,
And he's now got a template that we can start filling out for people.
yeah,
And everyone needs a fractional CFO slash operational finance
yeah.
thought partner. So we're gonna figure out like
Let's figure it
how to
out.
scratch that itch in
Yeah,
a way that might be beneficial to some of the people
yeah.
listening in because
No,
your mind is very rare of understanding how valuations, operations, and finance work. I think
yeah.
it's interesting.
Yeah, and it's such a big piece 'cause I mean, I even think about that finance layer is like that's base level. So you need the model. You need to know what's happening. You need to know what results are against that model. You need to know when to reforecast. You need to, kind of look at leading indicators. But then from there, it gets to be, kind of all the fun stuff when I said I jumped and I was like, "Ooh, I want to operate something," right? But like
Yeah.
now you can operate something because like I have to have this much to invest in it. And, this is the return that I can expect from it. And this is how I execute against it with existing resources or with like there's all those fun kind of trade-offs and decisions, the series of decisions that get to be made once you know what you have to work with.
And do you think that like because you've said because I feel the same way. You can't put me in a box. And I actually just did a personality profile for one of my clients recently, and it literally says I'm professionally unemployable. And like I'm just like there's zero
It's like
chance
no
you can
no
tell me what to
chance.
do. Yeah. But what I find fascinating, and like as I've learned the game of business ownership, capitalism, of finance, and free cash flow, the game's the same. And so when I hear you say, what's the next thing? For me, it's like, okay, I played soccer growing up. Like the game of soccer is the same every time. But the game that I'm playing today is different than the game tomorrow. I might play a different position. I might play different weather conditions and different team. And that's what I think of like whether you choose to be in the VC space or you own this business, but like the game is really the same. And like that's where it took me that long to learn how the game is played. And that's what I hear you is like you kind of synthesize how the game is played. Then I think, Candace, it's true. I think business can be one of the best vehicles for self-expression and self-actualization if we're using the ideas to then synthesize against the base rules of the game.
Yeah. Well, that piece, Ryan, and I think it's one of the best ways to have impact, you know?
Mhm.
And
Mhm.
this and at the end of the day, some of our pyramid is all around how we interact with others and how we help and support others. And um, I think the ability to like find your thing, and then be able to
Mhm.
share that in such a broad way, um, and triangulate with your North Stars all at the same time.
It's like
What better
it's the
way to
best
get
game.
there?
Yeah,
Yeah,
right, right. And like how to really get into the nuance
yeah,
and like what I think is truly possible. So like that flywheel, it's like time, cash flow, and wealth. You go, okay, I'm using my trade-offs today of how I'm spending my time, the ability to make my income and the wealth. Those all right now are tied to my goals
yeah,
of what they all should be in 4 years.
yes,
But then the escape velocity of like how I'm spending my time is creating value that will be a flywheel to then create more cash
more.
flow and more value versus like
Yeah,
you're spending your time and you're kind of having, you're wasting
right,
time
right,
hypothetically, but like,
right.
so it's like that total alignment is like,
Yeah,
and then you're doing more of what you love because
right,
and you got the freedom over the location of when you do that. Like,
right.
I don't know, like that sounds like a
That's life,
worthwhile.
right? Yeah,
Yeah,
like
right.
you have lived at that point.
Yeah. Yeah, like, I don't have to retire, do anything because
Right,
like, this is
right.
just fun
No,
every day.
exactly,
Yeah.
exactly. Oh, I love it.
This has been
We all
so
gotta get there.
fun. Yes. What's the best place to find you, reach out to you, or if people wanna get in touch?
Yeah, I keep it easy with just email me. So Candice, Candice at teambradleyandco.com. And we can set up a
Candace,
meeting. We can do
so
things.
fun.
Yeah. It's
We'll
been
have
so
to do
much
this
fun,
again.
Ryan. Yes,
This is a lot of
for
fun.
sure. And, maybe the next time we'll do it with the model.
Yeah, it would be interesting to have you walk through your thought
Yeah.
process on that. And just to be very clear, I didn't create the financial model. I have all of the ideas
Yeah.
and all of the assumptions. That's where then I would tap someone like you on the shoulder and go, okay,
What else?
well, do
The
this, do
starting
something with
point.
this.
Exactly. Yeah. No, I
Yeah.
love it.
All right.
This has been awesome.